already reeling from rising foreclosures, falling home prices, and contraction in the credit markets. Standing by to weave it all together for us is Alan Blinder, former vice chairman of the Federal Reserve and always an economics professor at Princeton University. Alan, welcome back to the show.
Good to be here, Kathleen.
So let's start by looking at oil. As oil climbs, we've seen gas climbing, and with the summer driving season, there's a view that the gasoline could climb even higher. What does this mean for the U.S. economy? Is it going to shove us into recession? Has it already? Or is it going to be an inflation problem?
Well, if we take possibilities, it's all of the above. Oil price increases are what we call stagflationary shocks. So they tend to produce stagflation, meaning more inflation, which was your third question, and also a stagnating economy. Now, in this case, it comes on top of an economy that's already stagnating for an entirely different reason, having to do with housing and foreclosures and things like that. Now, up to now, it has seemed clear, and I think it's still true, but becoming less so, that the housing problem is just dwarfing the oil problem. But as I say that, day by day, the oil problem is growing larger and larger and larger. It's certainly gone beyond where we can consider it as a negligible negative to the economy. It's not negligible anymore, that's for sure.
When we look at the trade numbers from March, Alan, we do see a pretty sharp drop in imports. Exports pulled back, still very strong, though. How does this fit into your view of the economy? And again, where do you say the economy is now? Marty Feldstein, at the beginning of the week on this show, said we're sliding into recession. Recently, Alan Greenspan said, well, this is a recession. It's a very pale version. What is Alan Blinder's view?
I'm not so sure it's a recession, but it's a lousy economy. You know, if you limp along at 0.6% growth, which is what the GDP growth was in the last two recorded quarters, that's not a recession. It's positive, but it's very poor performance. It's dismal performance. So it looks and feels a lot like a recession to lots of people. And of course, if you're in anything having to do with housing, mortgages, and most of the financial industry, you're in a recession right now. There's no doubt. If you're in housing, you're in a depression, in fact. But in terms of the overall economy, it looks like it's limping along positively rather than negatively. And I'm of the school that the rebate is going to do some significant good to consumer spending. Not everybody feels that way, but I think the evidence suggests that it will.
How much and why?
Why? Because you give, the simple answer is because these are Americans that are getting the money. And we know what Americans do with money. They run to the mall and they spend it. We're already seeing in the newspapers reports of clever retailers saying, bring your rebate check, we'll cash it free, we'll give you coupons, we'll give you discounts, and so on. The American retailing industry is marvelously inventive and very good at what they do. And they're also preaching to the choir. To consumers who like to spend.
So, Alan, you said the housing problem is dwarfing the problem of high energy prices.
But energy's catching up.
There you go. But let's turn to housing now, because it really is the 800-pound gorilla sitting in the room of the economy. You have urged, the government's taking steps to reduce foreclosures. Ben Bernanke, at the beginning of the week, his whole speech was devoted to this. Yes. Congress do more. Everybody do more. Yep. Randy Kroszner, Fed governor, said it's an urgent problem in the Fed's mind. Connect the dots. Why is preventing foreclosures so important in the Fed's view to preventing a recession, to healing the credit markets?
If we let this foreclosure epidemic spread, as it's been, so it is spreading now, so the question is, can we do something about it? If we just let it spread, let it run its natural course, diseases eventually peter out, epidemics eventually end. This is an epidemic. If we let the epidemic continue, there will be more foreclosures, there will be social, neighborhood damage, externalities on neighbors, literally on neighborhoods, on states, on cities, and there will be even more declines in house prices because of the fire sale inventory that gets thrown onto the market.
We're showing one of the heat maps that Ben Bernanke showed Monday night here in New York. We've got the change in mortgage delinquencies from 04 to 07, and no surprise, they are very, very high in the areas like California and Florida and in the Midwest, in the Northeast, where prices went up so fast and now are coming down so sharply.
Right. So as this continues, if the housing prices continue to spiral downward, that will first of all lead even to more foreclosures. So you have that so-called negative feedback loop. In addition to that, it will continue to destroy the value in mortgage-backed securities and financial stocks and things like that, which are at the heart of the problems that have now spread throughout the financial
Okay, Alan, we're going to hold it
industry.
right there. We're going to continue this conversation in just a moment. We'll continue our conversation now with Alan Blinder, former vice chairman of the Federal Reserve and economics professor at Princeton University. Alan, to kind of underscore how important this is to the Federal Reserve, again, in Ben Bernanke's speech, he made a whole case about why it's different now, why government intervention to write down principal is needed, because he says it isn't like this, you lose your job, you get foreclosed. Now we're showing the home price index that Bernanke showed. The red spots are the hottest areas where the prices have fallen the most. He's making the argument this affects a broad swath of people. It requires different action. He also had this very interesting map of the non-owner-occupied home. In other words, the areas where there was a lot of speculation. Again, we see the areas throughout parts of the West and Florida where this activity was rampant, also ripe for foreclosure. Again, what's the argument he's making? Why is this so important?
I think the Fed clearly sees the housing travails, so it's the interaction of the falling house prices and the foreclosures and the destruction of value of the securities that are built on mortgages, MBS and CDOs and so on, as the center of the problem that we're having in the whole economy. So it started there and it's filtered out. In the financial world, it's filtered out tremendously. In the real economy, it hasn't filtered out that much, but we're worried about the possible negative effects on consumer spending, for example, which was the rationale for the tax rebate that we were talking about a moment ago. So from the point of view of trying to manage the economy through this difficult episode so that we don't have a recession, or if we have one, it's very shallow and short, the housing problem is front and center in the Federal Reserve's mind. And that's how why you're hearing this from Bernanke, from Krasner, and lots of others.
So, and also why they, too, are focused on the legislation passing through Congress. Now,
yes.
Bernanke didn't specifically endorse Barney Frank's. No. He didn't endorse the Democrats' plan, but he does urge banks to write down principal. And the Frank plan, a plan which passed the House last night, would allow the Federal Housing Administration to assure refinanced mortgages after loan holders agree to cut their payments.
That's right.
Do you endorse this?
I certainly do. No, I absolutely endorse it. If anything, we need to go even further than that bill, which, as you probably know, was scored by the CBO as only impacting 500,000 houses. That sounds like a lot, but we got to get over 1 million, maybe to 2 million. I think that is no doubt the best option on the table right now. And so, yes, I wholeheartedly support it, and I hope that it'll get good support in the Senate and not get bogged down there. As you said, it passed the House, but I'm not sure it's even been formally introduced in the Senate yet, though it will be soon.
You know, Alan, in terms of this broad attempt, which, preventing foreclosure, shoring up the housing market is part of their attempt to staunch the problems in the credit markets. Another very important part, of course, is the special facilities the Fed has set up, like the TAF, where they've replaced treasuries with other kinds of securities that the banks really can't sell. They're pretty illiquid. But the question many people are raising as they add mortgage-backed securities, as they apparently agree to swap illiquid student loan-backed securities for treasuries, what's this doing to the Fed's balance sheet? What's it doing to their independence down the road? If Congress, is every problem going to mean, hey, Fed, bail out our baby?
Well, we certainly hope not on both of those last questions. Certainly not. It's no threat to the Fed's independence at this point. The Fed still has a pretty large unencumbered balance sheet. Your point is that some of it's getting encumbered right now, and that's correct. And in principle, several hundred million out of a balance sheet of about, I think, around 900 billion are so encumbered. But that still leaves the Fed a lot of sailing room if it needs it. Hopefully it won't need it that much. In terms of the take-up of these facilities, I don't know what to say except that I read the relatively low take-up. Now, mind you, when we're talking about numbers that are 15, 20 billion, if you went back 6 months ago, 8 months ago, that would have been considered unbelievably large. But today it looks small compared to some of the things that have gone on here and in Europe. It suggests to me that the banks are not quite as desperate for liquidity as they were previously. They still need it. They're still borrowing. Not quite as much. That suggests that the Fed's medicine, which has been focused on the short end of the curve and the liquidity problem is working somewhat.